What is up, YouTube? What's up, guys? The Composer Trader here, and welcome back to another post-trading analysis video. And today, we're going to be talking about how I managed to realize over 12% trading one single range in ETH using the same exact concepts over and over again. I think the total RR was around like 22, and I managed to realize around 12% of that because one short, as you can see on the chart, was actually a hedge and not a full position. But we're going to be diving deep into the dynamics that cause us to take these trades. But first, I want to let you guys know I took all these trades live, okay, inside of the TCT trading community in Discord, okay? So if you like my style of trading, if you like my style of teaching, definitely consider joining the Discord where we trade live each and every single day, trying to stack up those compounding gains to make you guys all financially free. Okay, like, come on now. That's the goal initially of trading. And after you've reached that, you're going to think about some other things. But that's not important right now. Okay, so we're going to be diving deep into the technicals behind it. So let me hide this group right here. And as always, I like to build some context. You guys know me. We always build some context in the chart. So on the higher time frame, what we basically have is just one enormous range here. Okay, we have a massive range in here. And right here, we had these equal lows. We were watching them for a while, right? We had these, they're not equal lows, but definitely a great sell side liquidity target. That was also the final TP of the short we took up here from that bearish period 3. That video is also here on my channel. And from there, following our market structure from top to bottom, we had a low, lower high, and lower low. Okay, so after taking out this low, we confirm that as our market structure high, and we draw a range from low to high. And then right here, we have our new range, where that range actually has initial range low, initial range high, and a deviation right now of that low. Okay, so obviously, once we have this bearish expansion towards the downside from the PO3, sweeping that obvious sell side liquidity, that can give the market maker the opportunity to fill potential longs to accumulate and reverse price back up when people most often least expect it. Okay, so looking at this range, obviously we left behind some supply worth pointing out right here, which is that kind of like that sell or buy to sell from that bearish PO3. So that's definitely valid to have on your chart. And then right here, you can see this 6-hour order block. That's actually right in that pivot point that created the second tap. So that becomes your extreme demand, but price already swept your extreme liquidity. So focusing on that first market structure low that gets created on the higher time frame. After putting in that second tap, we can see low, high, higher low, and higher high. And right here, we actually swept that first market structure low, which is considered your extreme liquidity. So price right there can already validate a potential Model 2 accumulation, which is pretty significant because it's the first high time frame Model 2 accumulation that we could potentially have on ETH right here in years. And when I'm telling you in years, it's actually in years. All this price action in here, I think up until right here, which was June, July 2021, we haven't had a accumulation of the same magnitude as this one, because ETH typically likes to create some sort of a divergence with Bitcoin, where Bitcoin takes a low, ETH doesn't. And obviously, when we're trading accumulations, we have to take those lows. But we know right now that, okay, we swept that extreme liquidity, rejected from that supply right above already, and kind of had an aggressive sell-off. So we could be in an accumulation, but it's not typically something that you like trading, because you had a very aggressive buy to sell, right? You had a very aggressive buy right here, back to sell, back to buy. So every time you have these aggressive V-shaped moves where price comes down right here, comes down, comes up, comes down, comes back up, you can expect price to range, okay? Price doesn't like to have these V-shaped moves. Every time it has these V-shaped moves, what follows afterwards is some sort of range. And you can see right now, we can already see obviously the aftermath, that after these aggressive V-shaped moves, we created just one big range, okay? We're just going horizontally. So whenever I see these aggressive V-shaped moves, let's say I did have an entry here, I would definitely want to be de-risked when we're ranging, because we're also building up some liquidity at the lows, and price can always go lower because we have a reason to, which is mitigating that 6-hour demand. But that's kind of the context that we're in, okay? Because the first trade was taken right here, which was Tuesday morning. So looking at the context, we know that, okay, we have these aggressive V-shaped recoveries. We can be in a higher time frame accumulation based off this market structure break, but I wouldn't be surprised to also range for a bit, potentially even go lower, take out these equal lows once more to truly sweep all that sell side liquidity, mitigate that higher time frame demand to confirm the higher time frame accumulation. So what I was basically seeing right here is I was looking at my structure and I'm like, okay, well, locally speaking, right, you kind of have something like this where you broke it back to bullish, and then what followed was a higher low for the higher high that was very steep, and then from there we SFP'd that high. So I wasn't really focused on price action having to put in a higher low, having to fully reverse. I was kind of looking for price action to create some liquidity in one direction, accumulate, and then have these range rotations that, can take a while because of the fact that I'm expecting a range because of these aggressive V-shaped moves. So I'm just checking price action right here. And from that high that we put in that swept that market structure high, I'm just seeing price slowly make lower highs and lower lows. Okay, I'm not drawing it super accurately right now. This is probably more so around 15-minute structure. Yeah, it's around 15-minute structure right here, lower highs and lower lows. And obviously, when we're making lower highs and lower lows, we can pull our range from bottom to top. And then right here, we have that first new range. Okay, we have that first new range. And I can see my initial range low. I can see my initial range high. I can see a sweep of the low. And what matters most right here is the fact and the way that price came down coming into that second tap, and also the price action after the second tap, because we can see just this amazing, beautiful return to zone. Okay, lecture 4 of the TCT mentorship. All these highs right here are stacking up to be lower highs compared to the previous ones. So you have one high, you have two highs, three highs, four highs, 5, 6, 7, 8, 9, 10, 11, 12. All these highs are stacking up to be lower highs compared to the previous one, with no supply in between. There's no supply, meaning there's nothing but liquidity above, no resistance. So if we get a confirmation to go long, the move up should be fairly easy. Okay, the move up should be fairly easy because of the amazing return to zone, which is a very good variable to look at to find those good trades. Okay, so the moment we put in that second tap and we go back up, we obviously have to look, okay, where could be our model 2, where could be our model 1. Now, for the model 1, we simply extend that range low to the deviation low and we watch for another sweep. Now, for the model 2, we have to see where is extreme liquidity, where is extreme demand. So right here on the 3-minute, I can see this pivot point order block, which is right there in that pivot point that create the second tap, which is going to be our extreme demand. And our extreme liquidity is not very easy and very obvious in this rangy price action. So when your extreme liquidity is not that obvious, but your extreme demand is, focus on the demand aspect. Most of the time you have both being pretty obvious, but if one is way more obvious than the other, focus on the one that is the most obvious, because you need to hit both or one of them, which is already enough to validate a third tap. So right here, initially speaking, we mitigate that demand zone, but in order to confirm it, we obviously have to break structure back to bullish of our most recent market structure coming into that third tap, which is right here making lower highs and lower lows. So, and obviously I'm drawing this following the 6 candle rule that's given to you in the TCT mentorship. And right here is that market structure high. And you can see we never broke that market structure high, but we took that low out prior to taking out that high, causing the high to actually change to right here. Okay. However, looking at how we swept that liquidity and how we came down, we can see now that we took that low, this becomes our actual third tap. But the way we came down locally from this high, okay, from this high all the way down to that low on the lower time frame, you can see locally we left behind an amazing return to zone as well, while coming down in a structured way. So looking at the most local structure that we can break back the bullish to confirm the entry, you can see right here we had this break of structure back to bullish. Okay, and because the return to zone is this amazing, you can just look at the lowest time frame market structure break that's available and enter on that. Now, looking at the timing, you can see right here it's 7:03. I didn't realize this setup until around 7:06. So I was kind of 3 minutes late because the live stream usually starts at 7, and then we have a little introduction. So we had to jump right into this trade because, guys, I took this trade live inside of the TCT trading community. And right here on this breaker structure is where I actually entered. Stop loss went below the low, and the target was the range high for a beautiful 1 to 4 trading this TCT Model 2 accumulation schematic. Okay, absolutely beauty. Great return to zone. Great market structure confirmation. And I'm not going to lie, guys. We retraced fairly deep after breaking structure, which is not something I was initially expecting. Because the return to zone was that good, but price was kind of struggling with the volume area low on that first tap, because you can see right there, we kind of rejected from that volume area low, and price wanted to sweep literally every bit of, or mitigate every bit of demand right here, because we had left behind this 1 minute demand zone that actually ended up putting in that higher low for the higher high. But I'm going to be completely honest, this was a retracement that was a bit too deep for my liking. However, once you enter the trade, you have a plan, you stick to it, and then, price went up higher, and it ended up hitting the target. Now, I had some people closing out their positions a bit too early, because by the time that we took the ETH, we also took Bitcoin, right? Because Bitcoin was forming the exact same model, but this video is going to be a bit more focused on ETH. And by the time ETH was right here, Bitcoin already hit its target. So Bitcoin had the chance to just reverse back down, causing ETH to never mitigate the target. However, what you simply need to do is, instead of taking partial profits that has a great chance of minimizing your RR in the initial trade with the expected return, you just simply need to put your stop loss to break even. Okay, so that's what we did. The moment we were right here, Bitcoin already hit its target. ETH was still lagging behind. You don't want ETH coming all the way back down again, because we are coming up fairly slowly. Also on the move up, leaving behind these lows, okay, leaving behind liquidity. So the moment, Bitcoin hits the target, you simply want to de-risk. You don't want to take profits. You just put your stop loss to entry, and you de-risk by putting a stop to entry, not by taking partials and that equal out the stop loss size, okay? Because you just don't want it coming down into this area overall, because then you're definitely going to take out all these lows that have been building up, right? So we had that Model 2 accumulation. Came up fairly slowly, but this is a great example where you simply, guys, need to stick to your initial plan and de-risk by moving the stop to break even, because that was the valid approach, not taking any partials, okay? Had some people taking partials, causing the RR to minimize, and then, instead of a 1 to 4, you catch at a 1 to 2, and then next trade you maybe take a loss and you're back to being up only 1% instead of that proper 3%. It can fuck with you in the long term, okay? So definitely move the stop to break even, and then let the trade play out, because Bitcoin was already a winning trade, okay? Now, you guys know, if you've paid attention to lecture 6 of the mentorship talking about advanced TCT models, that your accumulation can always go over in a distribution. And I told you guys, initially speaking, that I was expecting some range formation in here because of the aggressive V-shaped price action prior to that initial range starting in here. And the way that we came up was actually not what we were expecting, which was a fast move up. We had an extremely slow move up that took around, after entry, it took around 12 hours to hit the actual target, okay? And you can see on the move up, we were actually leaving behind a lot of sell-side liquidity. So I'm going to get rid of these taps at the lows and show you that, looking at this price action, we can see that price on the way up actually left behind a lot of liquidity, okay, where all these lows in here are stacking up to be higher lows compared to the previous one, right? All these lows are higher lows compared to the previous one. Trying to make a drawing here, but kind of failed. But again, the purpose of what I'm trying to say is that we are building up this liquidity below. So price loves to go where liquidity is located. And I was expecting a longer range overall. So there's a high chance that this accumulation may go over in a distribution, because the moment we swept this initial range high, price immediately broke structure back to bearish right here. Now, not on the 10-minute because it doesn't follow the 6 candle rule, but most definitely and certainly on the 5. You can see that right there. So you sweep the high and you break structure immediately back to bearish inside of the range. That's obviously not a great sign for potential future continuation out of the range. Okay. So from there, obviously, this is in the time where I am not really trading anymore. We're entering around that 10, 11, 12 p.m. going into Asia, and I'm not really that active around those times. And we can see right here that after breaking structure, that return to zone did nothing but just extend itself to be an even better return to zone, looking at this local retracement or a retest back up. So right here, we swept this extreme liquidity. It's not a typical market structure high as we usually have, but looking at the 10-minute time frame, there's no other high that's more extreme than this high because the high after is already second tap. So right here, you could have put in your third tap, and then that actually confirmed when price did not break structure initially here. We SFP'd it, but following your 2 levels of structure, if you zoom in, it doesn't matter that you SFP'd this low, because after you SFP it, if you still break your market structure on the retest leg back to bearish, so if you SFP this low right here, talking about this market structure pool right here, making higher lows and higher highs until you make a lower low, it doesn't matter. This is not a good break of structure because if you break that structure of that retracement leg up back to bearish, that's still going to be confirming a lower high right here, a lower high for a lower low to go back to that low, following your level 1 and your level 2 market structure. So the moment price broke structure in here back to bearish, that's when we confirmed that this model 2 accumulation is going over in a model 2 distribution that also has an amazing return to zone. Not only that, we actually also had a range inefficiency where you can see that all the volume in this total range is concentrated in the upper section in this premium pricing. So what that typically means is that if price starts to lose its volume area low, there's no volume in this area to really hold price back up. So you can expect just a move down because there's no active buying and selling previously. That's not going to protect price from going lower. Okay. So at this point in time, we confirmed that model 2 distribution, but that was around 4 a.m. for me. So you can see right here, this break of structure, it's around 4:15. So that's not when I'm awake, but when I was awake, that was around 7 as usual. And what I saw on the 15-minute time frame is that right here, after confirming the break of structure, we backtested for a lower high that left behind supply. So looking at the range, okay, looking at this range, we are in a confirmed model 2 distribution where the order flow objective is to come towards this range low, okay, because that's the technical target of the distribution. And this is the only supply zone that's left behind in this range. So price does have a valid reason to pull back because it wants to mitigate the supply before going lower. So because it's the extreme supply and there's no reason to go higher than that supply from a supply perspective, like obviously we can go higher to sweep more liquidity, but there's no supply located higher. This is your extreme supply. And therefore, if price comes back in there and we create a local return to zone and market structure breaks back to bearish, we can trade this because we know that this is your model 2 distribution. This is extreme supply, so it shouldn't go higher than that point. That becomes your new invalidation. We can enter here, take it down towards the range low. Okay, so when price was in here, I pointed out this supply zone, and I'm like, if price comes back in here, leaving a local return to zone, like obviously if we have a very aggressive V-shaped recovery coming into the block, I'm not looking at the block to short it because we're shorting an aggressive V-shape back up. But if you come down, I'll come up slowly, which is what we did, we can look for a flush play down because you still have all this liquidity below. And overall, the order flow objective is to come towards here. So we're trading in high time frame bearish context, which is good for our short. So looking at how price came into that POI, we can see that we are making higher lows and higher highs just like this. And we were coming up nice and slowly, right? Where on the lower time frame right here, we actually had 1 minute structure that broke back to bearish. Following this, high, higher low, higher high. Okay, boom. And that broke back to bearish right here. Now, I got a few questions. Lars, why did you enter on the 1 minute market structure break? Wasn't that a bit too risky? And the reason why this is not too risky is because we are rejecting from not just a supply zone, we are rejecting from the extreme supply. There shouldn't be a reason for price, if it wants to dump down, to go higher than this supply zone. So the moment that we mitigate it and then we break structure back to bearish, why would it have to take out that high again to then dump back down? It shouldn't. It simply shouldn't, because there's no supply in here remaining, even on the more refined level or above. This is the supply. It either rejects here or you go higher, sweeping all those highs out. So the moment we break it back to bearish, the clear invalidation for this supply zone to fail is if we take out that high again, because there was no reason to. So if we do it, we're probably going to go higher. So this is the invalidation. It shouldn't go higher than that point, especially after broke structure. So that's where we shorted. Now, this wasn't a typical short. Reason for that is because we still had around 30% of the long position from down there open. So the moment we came here, we cashed out 70%, realizing close to 4%. We still had 30% open with the stop loss to break even. So the moment this short opportunity came, I hedged my long. So I didn't close my long. I hedged the long right here to short it back down. So if this short got stopped out, my hedge long is still printing. And if this was going down, my hedge short was making me money. And my long was slowly going to break even with the profits decreasing. But this increase in profit on the short was more than the decrease in profit from the long. So you're basically in a win-win situation, especially because the moment price came towards the volume area low right here, we put our stop at break even, because there was one demand zone that could make price go back up, which was his extreme demand of the move that was overlapped by that volume area low. Just told you guys about that inefficient range. We had the volume area low being backed by demand, and we actually came down very slowly right here. Came down very slowly, leaving a liquidity trail above. So if we were going to mitigate this demand zone, price was most definitely going to go back up. Or right, if price was going to get a crazy bounce from this demand zone, breaking that structure back to bullish, following this lower high and lower low, then you're going to squeeze through all of this, which is literally our entry, right? So the moment we mitigated that demand, my stop loss got put at entry right here, just like that. And then I targeted this low in a risk-free trade. So the moment you are in a long and a short, both being risk-free, you're literally beating the markets, because it doesn't matter where the market goes, you win. Okay? Obviously, if you stop out the short, if something like this happens, you stop out the short and then you go lower, that would be the market maker messing with you, but there was no reason to go higher than that point again, because all supply was mitigated. So this short was a hedge and not a full position size. It just hedged out the long right there. So it was around 33% of my usual position size. So it was a 1 to 11. Take 33% of 11 and you have around 3 to 4% net gain. Okay, so this was close to a 4% gain. This was close to a 4% gain. And it was a complete hedge of the leftovers of the long. Okay, so that was basically this accumulation into a distribution play. But then something extremely interesting happened, and this is all, guys, explained in the TCT mentorship. And now we're going to go into the topic of low time frame ranges going over into high time frame ranges. It is explained. Lecture 6 of the TCT mentorship. It's right here on this channel underneath the playlist section. You can find it. Okay? Because the moment, if price wants to go over in a bigger range, you start off by creating your low time frame range that ends up having an accumulation. And then that could go over in the distribution, and that could deviate both ends of the range, making it on the higher time frame look like one push down, one push up, and one push down again, causing new high time frame range points to create that can go over in high time frame accumulation. So if we just listen to what I just said and look at it on the higher time frame to confirm it, we can see if I go on the 3 hour right now, you can see that looking at that initial range, this was the accumulation that we traded into the distribution right here. Like, you can't even see those points anymore, because if I'm on the higher time frame right now and I have to draw my market structure from that high, we have a high, we have a low, and we have a lower high, and now we have a lower low. So on the higher time frame, this is now my downward spool, making this my initial range low and making that my initial range high, and therefore making those points my new starting points right here with a low and a high. And then we can look for new accumulations. And that's literally how low time frame ranges go over in high time frame ranges. And right here, what was so significant behind all these trades that we took is that we always keep a great focus on that return to zone, because it just makes the trade way easier since you have such an obvious liquidity target. And funny enough, on the accumulation side, we came down very slowly, leaving that return to zone here, taking us or letting us take that trade to, reverse it back up. But then the move back up wasn't fast, but actually left behind this liquidity trail below. But then that was also not taken fast, because the way we came down, we left behind a massive liquidity trail above. So we completed each schematic slowly, which is a pain in the ass for us when we're in it, but it does allow for future opportunities to arise, right? So we had literally the most picture perfect liquidity trail right here, where there's no resistance. Like, this is even a better liquidity trail than this one or the one previous or prior to that, right? It was like picture perfect liquidity above. So we deviate that low, came back up. Now, obviously, guys, this retest, that's way too early. Okay, that retest is way too early, because this range is valid on the 2 hour, and like on the 2 hour, this just looks like one deviation. Okay, so we cannot look at this from a 1, 2, 3 perspective. We want to see a move up and a move down with some great time displacement to make it also look valid on the higher time frame. Okay, so looking at this entire move that broke structure right here, just like that, we can see that we left behind a structure demand right in this area, where this pullback, you can even look at it on the 10-minute, this pullback right here left behind this inefficiency that got mitigated right there, and making this our extreme demand. So when we later come back for it, that can be our third tap, because the third tap either needs to mitigate extreme demand or grab extreme liquidity. Okay, so this then became our new range, and the moment price was here, I let everybody know in the Discord, hey, this is the extreme demand that we're going to be watching. We have an amazing return to zone coming into it, and right here, I'm going to get rid of the curve. Like, the return to zone in here is amazing, and then you also locally create a return to zone from that high to the low, but that's harder to draw, because this is kind of its own liquidity curve right here. And then you have the liquidity curve from all the way up here, but it's not really one connected curve. Sometimes that happens, and it's hard to draw the curve. But if you pay attention to how price is acting, you'll realize that, hey, this is definitely a great return to zone. So we came into that POI, went a bit deeper than expected, and then we broke structure back to bullish, which obviously confirms the Model 2 accumulation. So right here on that break of structure, it was a bit of a deeper break. I think Trump was also talking at this time, but again, guys, we don't trade the news. We just trade the confirmations. I ended on the 10-minute break, so I'm going to check where that exactly is. There you go. That was the 10-minute break of structure. And I don't know why my trading view is giving a 7K target. Maybe it's a signal that ETH is going to break out. But this was simply the trade. But I did actually something very significant in this trade that increased my risk to reward. So I initially entered on the 10-minute break, because the 10-minute was the highest time frame that this structure pool was valid on. That closed right there. So then, Siri is trying to interrupt the educational session here. But I entered long initially right there. But on the push up, we came down so aggressive that we left behind structure demand, right? So right here on the lower time frame, you can actually see how demand was in control very well. So I'm going to get rid of my entry real quick. You guys know my entry is right there. But prior to breaking structure, you kind of initially started SFPing it. But looking at this on the lower time frame, you can see you're starting to create this upward structure, okay? And you initially SFP'd your breakout structure level, but then you were respecting the upward structure from the low up that created demand. So it truly shows that it's like a pivotal point in time where they're checking if supply is in control or demand is in control. And based on the fact that we push higher, right, on that, higher low, higher high, upward strength, it just showcases that demand is truly in control, wants to push price higher. But right here, we left behind structure demand that price ended up coming back for later on. And you can see, following your simple structure, you're making lower highs and lower lows until right here you break that market structure, okay? So you break that market structure right here, and we're overall expecting a higher low for the higher high because we broke structure here, never took that high. So following our level 1 and level 2 structure, this is your level 1. Let's make that red. Level 2 is in black. So when you break black, you're going to go back to red, and then you're going to probably complete the accumulation schematic. So right here, the moment we mitigate that demand, there's no demand lower. Like this is our initial invalidation because that's the third tap, but there's no demand lower than this point. Like it was a pretty deep mitigation. So the moment we start to break structure in here, what I simply did is my initial trade that was right in here with my stop loss below there for that 1 to 3 RR, somewhere like this, okay? That initial entry, that stop loss size was 1.3%. But after breaking structure right here, I trilled my stop loss to that retest low right there. I trilled my stop loss to this retest low. So that we're going from 1.3% in size to 0.7. That's almost a 50% reducement. So if I was risking $100 initially, I'm now risking around $50. Okay. And what I did is I wanted to keep on risking $100. So the risk that got diminished by trailing my stop, I added back on the breakup structure because my entry was already around this price point either way. Okay. And that allowed me to turn this trade from a 1 to 3 in almost like a 1 to 4.5. I think it was in the 4 plus, but not 5. Okay. So just that little extra trade management skill netted me over 1% in already this extra 1% in the same trade. It was already the same trade. It was nothing new, just a better refined RR after mitigating extreme demand. And that trade obviously ended up hitting its TP as well, giving you even a reaccumulation in the process, right? This is just such a great example. If you've watched the private lectures inside of the TC trading community, you know that that's an amazing trade to take based off the context. And from there, we literally, we longed the accumulation, and shorted it into a distribution, and then longed it into a higher time frame accumulation. Like, I don't know what else you want from price action, but that is literally, that's what we do, right? That's what we do. Like, if you pull it back up, now you see we literally longed the accumulation into a model 2 distribution short into a higher time frame accumulation long. And that went even into a low time frame distribution right there. It's like price was absolutely fantastic, guys. And price action like this, it just puts you ahead of the curve. You know what I mean? It's like we're always trying to compound that weekly profit goal of 5%, but this is then, you nailing. Last week we nailed 18%, 12% on ETH, over 5% on Bitcoin, little scalp in between as well. It's like little scalp on Doge in between as well, yeah. But it's like these weeks, these opportunities, they give you that little extra jump in your account balance, causing you to trade with a profit buffer the next week because you made so much profit the week prior, which also puts a lot of stress on your psychology away because you're not trading with your money, you're trading with profits, okay? Which is always way better, and then you're going to get into that positive spiral, causing you to trade better and better. So I'm telling you guys, all these trades were shared and taken live inside of the Discord community. So if you want to invest in yourself, if you like my style of teaching, if you like my style of trading, consider making an investment in yourself, in your future, and join the TCT trading community. The link is in the bio of this video. I appreciate you all for watching, and I'll see you all in the next one. Peace out.